It's good to get out every now and then. Yeah, we've taken a holiday to the river just to take stock of where we are as a family and plan the way forward. In this video, I'm going to look at an introduction to two stock systems, two inventory systems, the perpetual and the periodic inventory system. I'm going to compare a few transactions between the two systems. Basically, the inventory or stock systems are different ways of keeping control of the stock in your business. It's very important to keep control of the stock, and I'm going to show you the perpetual inventory system and the periodic inventory system. This is just a basic introduction to the two systems. I hope you enjoy the video. I hope you're finding the time to get your daily dose of vitamin D. There you can see the sun's rays shining down. Make sure you get your vitamin D. I'm going to look at these different scenarios with regard to the perpetual inventory system and the periodic inventory system. On this table, it shows you when stock is bought. In the perpetual inventory system, the stock is treated as an asset. But in the periodic inventory system, the stock is treated as an expense. When stock is sold, there are two parts to the sale. Part A, recording the sale, and Part B, at the point of sale, recording the cost of sale. What I'm saying now is not going to make too much sense, but I'm going to go through each scenario and I'm going to work through the transactions, a transaction with regard to each scenario. So this table here is just to point out the differences between the perpetual and the periodic. I will cover each difference in examples over the video. So when stock is sold, in the periodic inventory system, only the sale is recorded at the time of the sale. Scenario: extra stock costs to get stock to the shelves. So there will be transport costs or import duties, extra costs to get the stock onto our shelves. In the perpetual inventory system, these extra costs are added to the cost of the stock, the cost price of the stock. But in the periodic inventory system, carriage inwards, import duties, etc., they are all recorded separately. So in the perpetual, all these little extra transport costs and taxes are added to the cost price of the stock. In the periodic inventory system, all these extra costs are recorded separately. In the stock account of the perpetual inventory system, the inventory account, the trading stock account, is updated after each sale. Any movement with regard to stock in the periodic inventory system is recorded in a purchaser's account. And a purchaser's account is treated as an expense, whereas in the perpetual inventory system, the inventory account is an asset. So the stock account in the perpetual inventory system is updated after each sale. The trading inventory account is an asset. In the periodic inventory system, a new account is opened. Any movement with regard to stock is recorded in an account called purchases. And the purchases account is treated as an expense. The fifth topic is cost of sales. In the perpetual inventory system, cost of sales is calculated after every sale. Perpetual actually means ongoing. So in the perpetual inventory system, you will have an ongoing balance of stock in your trading inventory account, and cost of sales will be calculated after each sale. In the periodic inventory system, cost of sales is calculated at the end of the period. Say, for example, the end of your financial year, cost of sales will be calculated. In the periodic inventory system, the stock account or trading inventory only records opening stock and closing stock. All the other movements with regard to stock, all those movements get recorded in a purchases account. So you can see we have been dealing in all my videos previously with a perpetual inventory system, but now I'm introducing a periodic inventory system. And one big difference is between the two stock systems, I'm now introducing in the periodic inventory system a purchases account for any movement of stock during the year. The trading inventory account in the periodic inventory system is only used for opening stock value and the closing stock value. But more about all these scenarios over the course of this video. I will go through all the transactions listed here on this table, and everything will become a lot clearer. What I'll do quickly is just rub this out, and if you want to spend some time reading this table, just pause the video and you can see or read what I've just read or what I've just said. So you can have a look here at this table and you will be able to see the differences between perpetual and periodic. Transaction number 1. Okay, we're in the perpetual inventory system and the transaction is purchased inventory for 2,000. Let's make this 2,000 euros. We're somewhere in France. Paid cash for the items. Now, if you remember from previous videos, here are some steps to deal with the transaction. We've read the transaction, identify the accounts, classify the accounts, apply the rules. And I have here a summarized version of all the rules. You most probably have seen this on previous videos where I explained the rules. So we've read the transaction. We need to identify the accounts involved. Because it is cash, our one account that will be affected is our bank balance. And what did we purchase? Trading inventory. Now we need to classify these accounts. Bank is an asset. When we spend money, our bank balance will decrease, so the account will get credited. So on the credit side of bank, under details, we'll have the name of the contra account, and the amount was 2,000. So bank was credited. You must always apply your rules. Why? Because it was a decrease in assets, and the rule says a decrease in assets, the account must be credited. So we've purchased trading inventory. Trading inventory in the perpetual inventory system is an asset. The value of our stock has increased, and if trading inventory is an asset, an increase in the value of an asset, the rule says the account must get debited. So we debit trading inventory on the debit side. Under details, you got the name of the contra account, and the amount was 2,000. So what we have here is, just to recap, we're using the perpetual inventory system. We purchased stock for cash. The bank account was credited, decrease in assets. The trading inventory account was debited, increase in asset value of stock on hand. There we go. And Caleb is on the river. Remember, we're taking stock on the river, and he's trying to catch a fish. Good thing he's got his life jacket on in case he goes into the channel. So there we go. Purchase stock using the perpetual inventory system. Now using the periodic inventory system, I'm going to record the same transaction. Purchased inventory for 2,000 euros, paid cash for the items. Remember, if you're dealing with any transaction, you apply those steps and we apply the rules. So we need to establish which accounts are involved. Once again, in the periodic, our bank balance has decreased. Bank is an asset. A decrease in assets gets credited. But first of all, what is the other account? And this is very important. Any movement in stock during the financial year in the periodic inventory system goes through an account called purchases, not trading inventory, an account called purchases. And in the periodic inventory system, the purchases account is treated as an expense. So now we have identified our two accounts. What we need to do, we've actually classified them as well. Bank is an asset and purchases is an expense. Now, which account is going to be debited and which account is going to be credited? I mentioned earlier, our bank balance, which is an asset, has decreased. So the account will be credited. So on the credit side of bank, we're going to have the name of the other account involved in this transaction, which is purchases, because we're using the periodic inventory system. And the account, I'm stressing this, which records any movement in stock, is called the purchases account. So bank was credited. Why? Our bank balance decreased. Decrease in assets, the rule says credit. Purchases, which is an expense, gets debited because our purchases expense has increased, and the rule says an increase in expense, the account must get debited. And then we write the name of the contra account, which is bank, and the amount is 2,000. So in the periodic inventory system, we purchased inventory for 2,000 euros, cash, bank got credited, and the account purchases, which is an expense, got debited according to our rules. Any movement of stock during the period is recorded under the purchases account. Mother Goose has landed to check to see if my explanation is correct. What I've got here on this slide is a summary of this transaction. Purchase inventory for 2,000, paid cash for the items that were bought. So it's a summary of the previous two slides. At the top here we've got the perpetual inventory system as compared to the periodic inventory system. Stock was purchased. In the perpetual inventory system, bank was credited. In the periodic inventory system, bank was also credited because our bank balance decreased, and a decrease in assets, the rule says credit the account. But now here's the major difference between the two stock systems. In the perpetual inventory system, trading inventory was debited. Trading inventory in the perpetual inventory system is an asset. In the periodic inventory system, purchases was debited. In the perpetual inventory system, any movement in trading inventory during the year is recorded in the trading inventory account. So the balance of the trading inventory account, it would appear on the debit side of the perpetual system, should be the same if you went and did a stock count. So the balance in the trading inventory account should be the same as if you went and did a stock count of all the items on your shelf in your shop. But we know there could be theft and things like that. So it's highly unlikely when you do a stock take that the balance of trading inventory in our books will be the same as the stock take balance. But in the perpetual inventory system, all transactions relating to stock, when stock is bought or sold, or the owner takes stock for his or her own use, it will be recorded in the trading inventory account in the perpetual inventory system. Now, in the periodic inventory system, the stock, any movement of stock is recorded in an account called purchases. Purchases is treated as an expense. So in the periodic inventory system, all movements of stock are recorded in a purchases account. On this slide, I demonstrate the effect on the accounting equation of both the perpetual and the periodic inventory system. Paid for inventory cash 2,000 under the following table headings. Gain number, the document, what journal will this transaction be recorded in, which account is debited, reason, which account is credited, reason, and I show the effect of the transaction with both stock systems on the accounting equation. Assets equals owner's equity plus liabilities. So here's the perpetual inventory system first. Okay, the document we paid by check. The document we use to record this transaction is the check counterfoil. Where does this get recorded? CBP stands for cash book payments. You might call it cash payments journal. The account that was debited we saw previously was the trading inventory account. Why? Because there was an increase in the asset value of trading inventory. Which account in the general ledger was credited? Bank. And why? There was a decrease in the value of an asset, the bank balance. And what is the effect on the accounting equation? Under assets, we've got plus 2,000 because the value of the stock increased. And what happened to our bank balance? It decreased by 2,000. So we've got a plus and a minus of 2,000 under assets. There was no effect, a null effect under owner's equity, and a null effect under liabilities. And if you've seen my previous videos, the left-hand side of the equation will still equal the right-hand side. You can go check out my video on transactions and how they affect the accounting equation, and you'll get a better understanding of this table. But I just thought I'd put these transactions in the table in case you get asked like this in a test or exam. So that there is the perpetual inventory system, the purchase of stock. Let's have a look at the periodic inventory system. So it's the same. The document is the check counterfoil, cash book payments, and the major difference with this transaction. In the perpetual, the account that was debited was trading inventory. In the periodic inventory system, the account that was debited was purchases in the general ledger. And why was it debited? Increase in expense. And the same for both the perpetual and the periodic. Bank was credited, decrease in asset. Now there's a difference under the accounting equation when you compare the two. The bank balance, which is an asset, decreased by 2,000. Now purchases is an expense. What does an expense do to owner's equity? There's owner's equity. It decreased by 2,000. So we got minus 2,000 under assets and minus 2,000 under owner's equity. With these two systems, in theory, it all should work out the same at the end. Just during the process, accounts are treated differently. When we make a sale in perpetual, trading inventory is actually expensed, and a new account, cost of sales, which is an expense, is opened. But cost of sales in the perpetual is calculated after each sale at the point of sale. Cost of sales in the periodic inventory system is calculated at the end of the period. I will show you briefly as the video goes on the two calculations of cost of sales with the two different inventory systems. But the point of this slide here and where we're at, because this is just an introduction to perpetual and periodic, I wanted to show you the difference at the point of purchase of stock, the difference on the accounting equation. And the difference is Yeah. What we had here was trading inventory plus 2000, and yeah, instead of in the periodic, instead of having trading inventory at purchases, and what does an expense do to owner's equity? It decreases. So there we go. There's a difference between the perpetual and the periodic. Perpetual, they use a trading inventory account, and purchases is used in the periodic account. I keep stressing this. Trading inventory is an asset. Purchases is an expense. What will an expense do to owner's equity? It will decrease owner's equity. This brings us to transaction number 2. We had to pay for the delivery of the stock. Money was used from our petty cash. 500 euros was spent on the delivery of the stock. And we're in the perpetual inventory system. So we're looking at the carriage inwards of stock. We read the transaction, we use the steps to deal with the transaction, and we apply the rules. We've read the transaction. Now we need to establish the accounts involved. And money was taken from petty cash. So the one account is petty cash. Petty cash is an asset. Any cash is an asset. And we're in the perpetual inventory system. So what we're going to do according to that table right at the start of the video is the transport costs, or any costs involved in getting the stock to the shelf, is added to the cost of trading inventory. Trading inventory is an asset. So let's see which account is debited and which account is credited. Let's try figure it out ourselves. Our petty cash has decreased. So if we look at a decrease in assets, the account is credited. So on the credit side of petty cash, under details, we have the name of the contra account, and the amount was 500 euros. So if petty cash is credited, decrease in assets, that means trading inventory will have to be debited. But there must be a reason why trading inventory is debited. The value of our stock has increased by the amount of the delivery cost. The cost price of the stock has increased. So we're increasing the value of our stock. Increase in assets, trading inventory gets debited. And the contra account is petty cash. So let's summarize this transaction. We're using the perpetual, the ongoing inventory system. All transactions relating to stock inventory are recorded in the trading inventory account. Petty cash was used to purchase or pay for the delivery of the stock. Petty cash was credited, decrease in assets. Trading inventory was debited because the cost price of the stock that we've got on hands increased by the amount of the delivery, 500 euros. Remember, in the perpetual inventory system, all carriage or import duties or taxes on getting the stock to our premises, they're added to the cost price of the trading inventory. It increases the value of our stock on hand. Increase in assets, debit. If we're using the periodic inventory system, this is how that transaction is recorded. Let's just have a look again at the transaction. 500 euros was paid for the delivery of the stock, and we're using the periodic inventory system. Now remember, according to that table right at the start of the video, carriage or any costs involved in getting the stock to the premises or onto the shelf in the periodic inventory system is recorded separately. The cost is not added to the cost price of the stock. In the periodic inventory system, all these little extra costs with regard to stock is recorded separately. So we apply the steps, we read the transaction, we need to identify the accounts. Petty cash is being used to pay for the delivery of the stock. So petty cash is the one account. And what happens in the periodic inventory system? The cost of the delivery is recorded separately. Big difference to perpetual. In perpetual, it was added to the cost price of the stock. So now we're opening up an account, carriage inwards. Carriage inwards is an expense. Petty cash is an asset. Now we apply the rules. What happens to the petty cash account? The petty cash has decreased. A decrease in assets, the account gets credited. You really need to go and check my video on the accounting rules so you become an expert. So petty cash is credited. The name of the contra account is carriage inwards and the amount is 500. Carriage inwards is debited. Why? It's an increase in expense. And the name of the contra account in the carriage inwards account is petty cash. Contra account, just a reminder, it means the other account affected by the transaction. Now you have a cross-reference. You have a link between these two accounts because the contra account is recorded under details in each account. So there we go. We have in the periodic inventory system, we've recorded the delivery cost of the stock separately. And it's carriage inwards in this case. It's an expense. We could have also had import duties or custom duties. Those are costs involved in transporting stock. On this slide, the periodic inventory system is shown. All those extra little costs are recorded separately. In the perpetual, on the previous slide, the cost is added to the cost price of the stock, and the trading inventory account was debited. So we have the summary of transaction number 2 recorded in the perpetual inventory system and the periodic inventory system. This was the delivery transport of stock. That was the transaction. And in the perpetual inventory system, this delivery was paid with petty cash. Petty cash is an asset. The value of the petty cash decreased. The rule says a decrease in assets. The account must be credited. On the credit side of petty cash, you have trading inventory, 500. Trading inventory is the contra account. We're looking at the perpetual inventory system, and the account that was credited was trading inventory. And on the debit side of trading inventory, there under details got petty cash, and the amount was 500. So that's the perpetual inventory system, the delivery of stock. And the bottom line is, in the perpetual inventory system, any extra costs with regard to trading inventory, the trading inventory account is debited, increase in the value of the asset. So if it was import duties or custom duties or carriage inwards, trading inventory is debited in the perpetual inventory system. But in the periodic inventory system, trading inventory is only used for opening stock and closing stock. Any movements of stock, the purchase of stock or the sale of stock, is not recorded in the trading inventory account. Any transport costs or taxes with regard to transactions relating to stock inventory, they get recorded separately. In this case here, there was carriage inwards. In the periodic inventory system, we open separate accounts for all those little extras with regard to trading inventory. And petty cash was credited, decrease in assets. Importantly, yeah, a difference. Carriage inwards, instead of trading inventory, was debited, and it is an increase in expense. And have a look there. Caleb and Mommy, they're still counting stock on the river. And if we were to record this transaction, the delivery of stock, in this table, in case you're asked the table in a test or exam, it would look a little bit like this. Well, it would look like this. For the perpetual inventory system, the document would be the petty cash voucher. It would be recorded in the petty cash journal. The account that is debited is trading inventory, and the reason why trading inventory was debited in the general ledger with the perpetual inventory system, the value of trading inventory increased. Trading inventory is an asset, and the value of trading inventory in our books increased. Increase in assets, the rule says debit the account. What happened to our petty cash balance? It decreased. So the decrease in the value of the asset is the reason why petty cash was credited in the general ledger, and the effect on the accounting equation, under assets you got plus 500 with the stock value increasing, and minus 500 cash asset decreasing. The petty cash balance decreased. So the left hand side of the equation still equal to the right hand side. There's null effect under owner's equity and null effect under liabilities. Remember from previous videos, just to recap, what affects owner's equity? Drawings, income, capital, and expenses. So you know that acronym DICE. Those four categories affect owner's equity. Just a little bit of revision. Then, in the periodic inventory system, same petty cash voucher, petty cash journal. Any extra costs with regard to the stock is recorded separately. So an account for carriage inwards was opened with this transaction. It's an expense. We have an increase in expense. An increase in expense results in an account being debited. Petty cash was credited, the same as the perpetual inventory system. The value of the petty cash asset decreased. The rule says a decrease in assets, the account must get credited. Now the effect on the accounting equation is the same underneath assets with regard to petty cash, because petty cash, the value of the asset decreased by 500, and now there was an increase in expense because of carriage inwards. An increase in expense results in a decrease in what the owner is worth. So here it is minus 500. It is typed in there. And nothing happened under liabilities. So hopefully you see the difference here on how this transaction is recorded in the perpetual system versus the periodic system. There you can see a difference. Carriage inwards minus 500. And what happened here with that carriage inwards, it was added to the value of stock. That's why there's plus 500 under assets. But like I've mentioned before in this video, at the end of the period, when we do calculate cost of sales, the net result for both these methods in theory should be the same. So there's just a different process in recording perpetual and periodic. Because remember, when we make a sale in perpetual, trading inventory is what we say expensed, and a new account is opened, cost of sales. We will see that in the next transaction. And on the river, we made time while we were taking stock to take a few selfies. You must have some fun. The grains of sand in the background here are actually, it's a picture of the sand we walked on up the river. There you can see Caleb's footprint. Right, transaction number 3. Sold the inventory purchased in transaction 1 for 4,000 euros. This stock was sold on credit to the school. So we follow these steps, read the transaction, identify the accounts, and there I've popped one up already. Debtors control. These items were sold, the stock was sold on credit. So that brings into account debtors. We've sold it to a client of ours, the school. We sell these videos to schools, but in this video, the name of the client is the school. And if we sell on credit, the school becomes a debtor. Now, you might know this account here, debtors control, as accounts receivable. It records, it's a summary of all the individual debtors to whom we've sold to on credit. A control account, debtors control. Right, there are two parts to this transaction in the perpetual inventory system. The first part is record the sale. So part A of a sale in the perpetual inventory system is record the sale. So debtors control is one account and sales is the other account. Debtors control, a debtor by definition is an asset, and the value of the debtors control account has increased by 4,000 because debtors owe us more. An increase in assets, the account gets debited. So on the debit side of debtors control or accounts receivable, however you want to call it, we have the name of the contra account, sales, and the amount of the sale is 4,000. Remember, I'm ignoring any taxes here, VAT or general sales tax. All these transactions, I'm just illustrating the difference between perpetual and periodic inventory systems, and we're not dealing with tax at the moment. So debtors control is an asset. Increase in the value of assets, the account gets debited. On the debit side, under details, got the name of the contra account and the amount. Sales 4,000. So debtors control was debited. The account that is credited is sales. Now sales is classified as income, and there has been an increase in income revenue, and the rule says, there's the income rule, an increase in income, the account must be credited. So on the credit side of sales, we will have the name of the contra account, debtors control, and the amount was 4,000. Now in the perpetual inventory system, that is part A of a sale. Now part B is recording the cost of the sale. So at the point of sale in a perpetual inventory system, cost of sales is recorded at the point of sale. In the periodic inventory system, cost of sales is recorded at the end of the period. But we're looking for the moment at the perpetual inventory system. The sale was of stock. The selling price was 4,000. We've done part A. We've recorded the sale. Part B, we need to record the cost of the sale. Now there are two accounts involved with part B. At the point of sale, trading inventory is what we say expensed, because this sale came with costs, and the cost of the sale was the cost price of the trading inventory that we are selling. So cost of sales is an expense. The expense has increased, and the rule says an increase in expense, debit the account. Now trading inventory is an asset. Now I have put here in blue 2,000 rand or euros, because we're in France. 2,000 euros worth of stock was purchased in transaction 1. Then there was carriage inwards. So the total cost of the stock is 2,500. I haven't recorded these transactions here formally in this slide, but they were done in slide 1 and 2, previous slides. Now what has happened, all the stock has been sold. This is a very basic example, but what we need to do is we expense the trading inventory by opening up an account cost of sales. Cost of sales gets debited. As I mentioned, an increase in expense, the rule says debit. The contra account, the other account affected by Part B, is trading inventory. And what happened to trading inventory? Trading inventory was credited. Now a decrease in assets because this stock was delivered to the school. It has left the premises. We cannot show that this stock here is still on our shelves if we were selling a physical product. So trading inventory was credited, a decrease in assets. Now we've got here Part B, debit cost of sales, credit trading inventory. If you balance this account, and if you go and check out a video on balancing general ledger accounts, after these transactions, trading inventory will actually have a null balance because all the stock was sold until we purchase more stock. Now the advantage of this particular method of recording inventory, perpetual inventory system, is cost of sales is calculated after every sale. The periodic inventory system, cost of sales is only calculated at the end of the period. Now the perpetual inventory system therefore has an advantage over the periodic inventory system because after this sale of stock I can straight away know a few things, and one thing I know is the gross profit, because gross profit is sales of 4,000 minus cost of sales 2,500. The gross profit before operating expenses and other income is equal to 4,000 minus 2,500. So cost of sales is calculated at the point of sale in the perpetual inventory system. The gross profit, if this was the only sale, the only transactions for the business at this particular point in time, is 1,500 euros. So I'm pointing out an advantage of the perpetual inventory system. I can calculate gross profit on each sale, or I can calculate the cost of sale after each sale. In slides in the future, as we go along in this video, I will show you how that is normally done. It will be a percentage of either the cost price or a percentage of the selling price, cost of sales. But I will explain that. So let's just recap here. It's quite a mouthful. I'm in the perpetual inventory system. By the way, I can also have a running balance of trading inventory in the perpetual inventory system. Another advantage. This year you might have to watch a few times because I'm explaining quite a bit. Now, sold inventory, purchased in transaction 1 and 2, transaction 1 and 2, for 4,000 euros. Part A, debit, debtors control, you can call it accounts receivable. Increase in assets, that's why it was debited. Sales, was credited, increase in income, part A, with the selling price. Part B, expense the trading inventory. I'm going to take that out for now. If I expense the trading inventory and I'm only looking at this transaction, cost of sales is debited, increase in expense. Trading inventory is credited, decrease in assets. And the cost price was 2,500, which consisted of the stock that was purchased earlier and the 500 that was used or paid to deliver the stock to our premises. So that's the perpetual inventory system, how to record a sale of stock. After that previous explanation on the perpetual inventory system recording the sale, my beautiful wife had to have a cup of tea to take a break, and I needed some vitamin D. There you can see it shining down on me. But we need to carry on, and I'm now going to show you how to record a sale using the periodic inventory system. This is much easier because cost of sales is not calculated at the point of sale. It is calculated using a formula at the end of the period. So the periodic inventory system, from an exam point of view, if you're asked the periodic inventory system, it is much easier because you don't work out cost of sales after every single sale. So maybe you get it. But perpetual is used 90% of the time. But if you get the periodic inventory system, it should bring a smile to your face, because you are going to record cost of sales only at the end of the period, not after each sale. So let's look at this transaction. We read the transaction. Sold the inventory purchased in transaction 1 for 4,000 euros on credit, once again to the school. We identify the accounts involved. It was on credit, so we got debtors control, or you call it accounts receivable, and we got sales. So the two accounts, debtors control or accounts receivable, don't want to confuse you. The important thing is, whatever you call your debtors, the debtors control account or accounts receivable, as long as you're treating that account as an asset, because a debtor is an asset. An increase in the value of the debtors owe us more. Increase in assets, this account must get debited. And the account that is credited is sales. So increase in assets, debit. On the debit side, we write the name of the contra account, the other account, sales 4,000. And sales is income. Our income has increased, an increase in income. The rule says credit. And we write the name of the contra account, debtors control, and the amount was 4,000. And that is it for the periodic inventory system. Because cost of sales is not calculated at the point of sale. It is calculated at the end of the period we are recording transactions for, at the end of the period. That's why it's called the periodic inventory system. Perpetual is definitely better. There's tighter control than the periodic inventory system. But the periodic inventory system is cheaper to set up. perpetual, you might need software, and it's easier if you only have a few items that you're selling. But a periodic inventory system, if you have a store that's selling thousands of different products, it might be just easier to set up the periodic inventory system. Perpetual, let's say you're selling 5 luxury items. It's quite easy to work out the markup on the cost price after each sale, and therefore cost of sales can be calculated after each transaction. Let me summarize here. I'm giving extra information and I might just be confusing you and talking too much, so I'm going to summarize this transaction using the periodic inventory system. We don't record cost of sales at the point of sale. This was on credit, so we debit debtors control and we credit sales. Remember, all these transactions do go through journals before they get to these T accounts, which represent ledger accounts, general ledger accounts. So to summarize what I just did, we made a sale on credit to the school, one of our clients, and I'm going to demonstrate how this is recorded in the perpetual, the ongoing inventory system, and the periodic inventory system. So the transaction of a sale is being compared here between the perpetual and the periodic. So in the perpetual inventory system, there are 2 parts. Part A, record the sale. So the account that was debited was debtors control, accounts receivable, increase in asset. The account that was credited was sales, increase in income. We calculated the cost of the sale. Cost of sales is an expense, and increase in expense, cost of sales was debited. You might just pick up here, there's an error, there's a typo. That amount should be 2,500, which consists of the 2,000 that we paid for the stock plus the 500 delivery. That makes the cost of the stock 2,500. Because in the perpetual inventory system, any costs, extra costs with regard to stock, is added to the cost price of the stock. And there I can actually change that there to 2,500. So cost of sales was debited, increase in expense, and trading inventory was credited, decrease in assets, 2,500. That is the perpetual inventory system. Now the periodic inventory system is easier because cost of sales is not calculated at the point of sale. So there's the transaction. Debtors control was debited with the selling price 4,000, and sales was credited with the selling price 4,000. Under details, you got the name of the contra account, and the same in the debtors control account. Under details, you got sales, which is the contra account, and there is no cost of sales. So the periodic inventory system, it's easier in a test or exam because you don't have to calculate the cost of sales at the point of sale. I will do a video on the calculation of cost of sales in a perpetual inventory system. But for now, I'm just introducing the major differences between the perpetual inventory system and the periodic inventory system. So that there was an example or the summary of recording a sale in both the perpetual and the periodic inventory system. So it was a comparison of the two. There you can have a look at which accounts were debited and which accounts were credited with both systems. And if the examiner asks you this format here, you're given the table and they say record the sale of inventory. The selling price is 4,000. If a stock is sold on credit, the document that we use to record this transaction is an invoice. We issue the original and keep the duplicate. So the document that is used to record a sale in the perpetual and periodic is an invoice duplicate. This transaction gets recorded in the debtors journal, and the account that was debited, this is perpetual. Well, let me pop that in there. The perpetual inventory system, debtors control was debited. That's part A of the sale. I could actually write here A, and that there is part B. So in the general ledger, the account that was debited was debtors control, and the reason a debtor is an asset, increasing the value of assets in our books. The account that was credited was sales, increase in income, and the effect on the accounting equation, plus 4,000 under assets and plus 4,000 under owner's equity. Income from the sale increases owner's equity, plus 4,000. Then part B, the inventory was expensed, and we opened an account called cost of sales, and cost of sales was debited, increase in expense. The rule says increase in expense, the account must be debited. And trading inventory, the stock left our shelves and was delivered to the school. It's a decrease in assets and a decrease in the value of the asset trading inventory. The rule says the account must get credited. And the effect on the accounting equation, our stock has left the building, minus 2,500. And what does cost of sales, which is an expense, do to owner's equity? It decreases owner's equity by 2,500. So that was the perpetual inventory system. And now we have the periodic inventory system, and we record the sale in the periodic inventory system. The document, once again, the invoice duplicate, recorded in the debtors journal, debit debtors control. There's the reason. Credit sales, there's the reason. And what is the effect on the accounting equation? Plus 4,000, because our debtors owe us more. And what is income due to owner's equity? Plus 4,000. Remember, in the periodic inventory system, cost of sales is recorded at the end of the period, not at the point of sale. So there is no, in the periodic inventory system, there is no recording of cost of sales at the point of sale. So periodic, easier. I've put the transactions all together on a table, and this here is of the perpetual inventory system. So this is just a summary of what's happened in the video before. The first one was a purchase of stock paid cash. The second one was paid for the delivery, the second transaction. And the third transaction was a sale of the stock that was purchased. So I've put it together for you to have a look at. I've explained this slide before in previous slides, so you can have a look here at the perpetual. And perpetual, remember, cost of sales is calculated at the point of sale. The trading inventory account is being used for all the transactions that relate to trading inventory. So the perpetual inventory system is more efficient because you can do certain calculations after each sale, but some businesses still prefer to use the periodic system. And I cover the periodic system in case it's asked in an exam. These are the same transactions in the periodic inventory system. Number one was the purchase of stock, and I pointed out a very big difference. A different account is used in the periodic inventory system for movements of stock during the year. So the purchase of stock was made, and in the periodic inventory system, not trading inventory account is used, but purchases. And the purchases account is treated as an expense. And what does an expense do to the owner's equity? It decreases the owner's equity. So what I'm telling you now are the differences that a periodic system has as compared to the perpetual inventory system. The second difference, any costs that are a result of stock being transported to our premises, custom duties, any taxes, import duties, they are recorded in the periodic inventory system separately. In the perpetual, all those little extra costs are added to the cost price of trading inventory in the perpetual inventory system. It is recorded, all those little extra costs, in the periodic inventory system separately. So we open up here, in this case, an account for carriage inwards. It was debited. Why? Carriage inwards is an expense, increase in expense, debit. We paid out a petty cash. What did that carriage inwards do to owner's equity? An increase in expense decreases owner's equity. So there's a big difference here in periodic. Purchases account is used when stock is purchased. Carriage inwards account is used for the delivery costs. It's not added to the cost price of the stock in the periodic inventory system. And when a sale is made in the periodic inventory system, cost of sales is not recorded at this point of sale. So here are three major differences as compared to the perpetual inventory system. In this slide, I'm going to show you Our cost of sales is calculated in the periodic inventory system. It's recorded, or cost of sales is calculated at the end of the period. And here is the formula to calculate cost of sales in the periodic inventory system. You take the amount for opening stock, which would have come from the only time trading inventory is used, the account trading inventory is used in the periodic inventory system, is to record opening stock and closing stock. We're going to say the value of opening stock plus the purchases made during the year, the period, plus all those extra expenses like carriage inwards, import duties, and I've just written here other costs involved in purchasing the stock. Then a stock take is done, everything is counted on the shelves, and it is subtracted from the above, and that will give you cost of sales. So maybe let me just give you an example with numbers that I've made up. To calculate cost of sales, we get the opening stock, we add the purchases made, we add carriage inwards, we add import duties, we do a stock count, and we subtract from this number here. If you add those all up, you subtract the value of the closing stock, calculated by doing a stock count, counting everything on the shelf at cost price. And these numbers subtract the closing stock is equal to the cost of sales. In this case, 11,450. If I use the examples that I've used in this presentation, we didn't have an opening stock, so let's say this business has just started. I remember purchases were made for 2,000. There was carriage inwards of 500. That was petty cash. That's 2,500. And all the stock was sold. So how much was the closing stock? 0. What was the cost of sales? For our video, 2,500. 2,500. The purchases was 2,000. Carriage inwards 500. That's 2,500. There was no stock left on the shelves, so the cost of sales was 2,500. In the perpetual inventory system, cost of sales can be calculated as follows: the rand amount, or a percentage, but let me show you here. In our example, the cost price of the stock that we purchased was 2,500. Now the business, or your business, can decide to make a markup on the cost price or a markup on the selling price, and that they give it normally in a test or exam. They will say the percentage markup on cost price or selling price, they give it to you, let's say is 50%. They give you the selling price and you have to calculate the cost price. They can give you the cost price and you have to calculate the selling price using the percentage. But after every single sale, you can calculate the selling price, the cost price, the percentage, and the percentage markup is either a markup on cost price or a markup on selling price. The examiner will give you the details and you will have to calculate, most of the time, cost of sales, the cost price, when given the selling price. In our example, the cost price, I gave you the actual values. The cost price was 2,500. The items were sold for 4,000. The markup was therefore 1,500. 4,000 minus 2,500 is equal to 1,500. The markup is also known as the gross profit. If I want to work out what percentage that is, the markup on cost price percentage, markup is 1,500. We calculated it, divided by the cost price over here, which is 2,500. And if you want to calculate a percentage, you need to times by 100. You can work that out on your calculator. I think it's 60%, but you can work it out. 1,500 divided by 2,500 times by 100. I think it's, if I look at it quickly, that simplifies to 3 over 5. If you divide by 500, divide by 500, 3 first times by 100 equals 60%. So the markup percentage, the markup on the cost price is 60%. The markup on the selling price, 1,500, markup is 1,500, divided by the selling price, which was 4,000, times by 100 will give you the percentage. This here is 3/8. I divided the numerator by 500 and the denominator by 500, and I get 3/8, and if I multiply that by 100, 62.5. Now, I'm going through this very quickly because I'm going to do a whole video on the calculation of markup on cost price, markup on selling price, the selling price, the cost price. The examiner can ask you to do all these calculations in the perpetual inventory system. And you can now see that the periodic inventory system, from a student's point of view, is much easier because we just use a formula to calculate the cost of sales. Here we're throwing in quite a bit of maths to calculate the cost of sales and selling price, and then as things get more involved, there might be VAT. These items here exclude VAT, and if you do general sales tax, it will exclude general sales tax and VAT. So I'm going to end this video here. All these calculations I will do in a separate video, markup on cost price, markup on selling price, but I thought I would just introduce this in this video so you have an idea going forward. Look out for the video on these calculations. Well done, everyone. That was a long video, and I hope you now know the difference between the perpetual inventory system and the periodic inventory system, the main differences. This is just an introduction to those two stock systems. I hope you are finding time to take stock of where you are at the moment. We made a week and we went away. We had a fantastic time just to revitalize and plan the way forward. I hope you get the time to do the same thing. I hope you enjoyed this video. See you all soon. Cheers.